So now it's my great pleasure to present Ann Spehar, and she is our assistant professor in economics at the University of Alaska Southeast. She was born in Fairbanks, and she is responsible for designing, developing, and instructing online asynchronous courses in money and banking, international economics, intermediate macroeconomic theory, and principles courses. Ann Spehar earned a master's in applied economics at Seattle University in Washington State, where she also earned 2 undergraduate degrees in economics and math at the University of Washington. She holds a master in education and curriculum and instruction from Montana State University and has 2 years of study toward a doctorate degree in economics at Washington State University at the University of Calgary in Alberta, Canada. Spehar's field of interest is the theory of endogenous business cycles. She has studied the 1930s U.S. Great Depression extensively and has compared it to the 2008 financial crisis. She has also recently published 2 papers on that topic in the World Economics Journal, and she has also published in the International Journal of Wilderness. So will you please join me in welcoming Ann Spehar?
Well, thank you for joining us this evening. What we're going to talk about today, this evening, is the fractional reserve banking system. Now, there's a lot of ideas that a lot of people are have a lot of, I should say, false ideas about what the fractional reserve banking system is, and so I'll talk just a little bit about what the banking system is, first of all, and secondly, what some of the responsibilities of the banking system are, as well as how it goes about creating money in the economy. It turns out that an elastic money supply is not a bug in the system, elastic meaning that it grows and expands and contracts with GDP. It's not a bug, it's actually a feature. Anyone who is familiar with cryptocurrencies, they tend to believe that you want a fixed supply of the money supply, and that actually turns out to be a bad thing because it tends to create bubbles and turns the money into assets rather than a currency, which is exactly what we're seeing in cryptocurrencies. And so what we'll do is we'll start out today just talking a little bit about why we want to control the money supply, and then I'll go about an example of using a specific policy tool that the Federal Reserve actually uses in managing the money supply. So first of all, the fractional banking system is a mixture. It's one of the it's a unique structure in the world. England, Canada, Europe, all have completely public banking systems. We don't. Ours is part private and part public. The public part is the 7-member board that is elected by the president and controls monetary policy for the most part. So does the FOMC. And the FOMC consists also of the 7 members of the board, as well as on a rotating basis a few of the Federal Reserve branch banks. 3 of them actually that are added to the FOMC. So it is a pleasant mixture of both public and private, but the private does have a very strong say in monetary policy. So, and I also want to mention that the 7-member board that manages and controls monetary policy, they're elected by the president, and the Senate gets to approve it. And in addition to that, there's a congressional mandate that is given to them that makes them responsible to maintain a stable currency, a stable price level. How many of you are familiar with cryptocurrencies? Well, I don't know if any of you have been watching them, but the price of the cryptocurrencies are pretty, what we call volatile. How would you feel about going to the store and buying a loaf of bread and not knowing what the price of that bread was going to be when you got to the point of actually purchasing it? That's why you want a stable money supply. You want the price of money to be fairly stable so that there's some kind of consistency in what prices are all about when you go and purchase your products as a consumer. And so one of the congressional mandates is that the Federal Reserve maintain a stable price level. And the way it goes about doing that is by controlling the money supply, allowing it to breathe with the economy, breathe in the sense of expanding when GDP grows. so that there's more currency in order to purchase goods and services, and contract when the GDP contracts. And so you want an elastic currency, and that's one of the fundamental responsibilities of the Federal Reserve System, to allow this, to allow our currency to be elastic and breathe with the economy. And so we need. It actually turned out in the 1800s that many of the farmers that would go to New York or Chicago and would try to sell their goods, there wouldn't be enough money in the system to actually make the purchases and borrow and invest as they needed to during the times when they were selling their products. And so it was very often that many of these downturns happened at this time, because the currency just simply wasn't elastic enough. And in addition, you can imagine in seasonal, we're all buying goods and services during Christmas. You need a more flexible currency during the seasonal quarters as well. And so you need a system that responds to these kinds of demands, money demand, if you will, and that's one of the main responsibilities of the Federal Reserve. I should also say there's one other congressional mandate, and that is to create the necessary conditions for a strong employment. But there's three main tools that are described on the Federal Reserve Board website that they use or have used in the past to control the money supply. One is interest rates. Interest rates, of course, we tend to think of interest rates as being the price of money. That is, if you borrow money, that's the price you're going to end up paying to borrow money. And then open market operations, which is buying and selling treasuries, and that allows the Federal Reserve to, if they purchase the treasuries, it puts money into the system, and if they sell them, of course, then it takes it out. And then finally, we have reserve requirements, and that's what we're going to talk about today. This specific policy tool of reserve requirements and how they go about setting these reserve requirements, and how this can end out actually creating an increase in the money supply by private banks for the most part. So we call this a fractional reserve system, and you'll see why we call it fractional in a few minutes. But we're going to start out talking about money as it exists in banks account. And I'm sure most of you are familiar. You have deposits in the bank, right? All of you put your deposits, and your checks go in as deposits into banks. I'm going to assume that when I say banks, I'm also talking about thrifts as well. So what we're going to learn here is that money enters the system through loans. So private banks are going to make loans, and they're going to create brand new money in the process of issuing loans. And they're going to do this, of course, by lending. And when banks make loans, these new deposits are then created. And I do want to point out that it's not the only way that new money can enter a system, right? There's many other ways as well. QE, I'm sure all of you are familiar with QE. There's other techniques that you can actually get new money, into the system. This is only one way. And the Federal Reserve controls this mechanism, and the way that it controls it is through reserve requirements, and I'll show you what that is. So we're going to start out by assuming that banks rely only on what's called reserves, which are held at the Federal Reserve Bank. There's actually 12 of these Federal Reserve banks throughout the nation. But private banks have banks, just like you and I have a bank, and those banks are called Federal Reserve banks, and there's 12 of them throughout the country. Alaska belongs to the bank in San Francisco. Most of the Pacific Northwest and California, etc., belongs to the San Francisco Bank. And that's where all private banks bank. They bank at that particular bank in San Francisco. And that bank, there's 12 of them. There's one in New York and one in Philadelphia, etc. And of these 12 banks, they're members of the Federal Reserve Board. So they're private, but the Federal Reserve Board itself, the 7-member, is public, elected again by the president and approved by the Senate. So the Federal Reserve is going to control the reserve requirements, and I'm going to define what that means in a moment. So just hang on to your thought there. We're going to assume that banks only rely on these reserves that sit in these reserve banks for federal funding. And what I mean by federal funding is funding for loans to loan out to consumers. Okay, so if a bank wants to make a loan, it's going to go to its reserves at its own bank in San Francisco, for Alaska, and loan out its excess reserves. And we're going to call this system the fractional reserve system. You'll see in a moment why it's called fractional. So our objective today, and we're going to illustrate the actual process of money creation in the economy by private banks. And we're going to do it by starting out by creating our own bank. Okay, so we'll start out with a bank's balance sheet with assets and liabilities, and we'll pretend that we're a bank ourselves, and then we're just opening it up for the first time, and we'll go through the process of what we need to do and how we're actually going to go about creating new money in the economy. So we're going to consider the necessary transactions that result in an increase in the money supply. And we'll do this first for just one bank that you and I end up creating, and then we'll do it for the economy as a whole. And we'll see there's a little bit of a difference in how much money actually gets created for one bank as opposed to all of the banks in the economy. Okay, so we'll consider each of the transactions. And so what we're basically going to do is just a bunch of simple elementary bookkeeping. And we're going to explain how banks use these accounts to keep track of and compute balances while always maintaining the balance, assets and liabilities always has to equal on both sides. And in this process, we'll show how private banks create money. So here's our first bank. We're going to start out as a bank. We'll call ourselves a prudential bank. How's that? That's, we want to be prudent. We want to be responsible, right? So we're going to start out with selling stocks to somebody. We're going to go out into the public and say, hey, who would like to buy some stock in my bank? And we're going to sell a bunch of shares. And we sell $250,000 worth of shares, okay? That ends out being cash to us, right? So we end up creating the prudential bank. Okay, and this bank so far just has a bunch of cash, but that's not really going to do us a whole lot of good, right? Because we need kind of a big building and computers and a bank vault cash, to put our cash, and so we need a lot of things. So what we'll do is we'll go out and take some of that money and we'll buy ourselves a building, some property, and get some equipment and stuff, and so allow ourselves to be ready to take on deposits. And so we do that. We take of $250,000, we buy some property, and of $240,000, and we only have $10,000 cash left. So you can see on the asset side, how do I do this? Let me see. How do I do this? Yeah. So you can see assets here. What we have is we've got the property of $240,000 and cash of $10,000, and of course we have the liability to our stockholders of $250,000. So far, so good. But now we're ready to take on checkable deposits. And this is kind of interesting because a lot of people don't know this. You know that when you put your checkable deposits into the bank, did you know that it's no longer yours? I love saying that because people go, oh, really, what? Legally, you're actually loaning it to the bank. The bank gets to do what it wants to with it, but it is a big, huge liability to the bank, right? Because you get to write a check on that whenever you want. That's the contract. And so the contract has it that even though the bank owns it, right, it's still you get to write a check whenever you want, and the bank is liable to provide those funds for you. And so as we take on $100,000, and so what do we have as cash now? Well, we had our original $10,000 cash, and now we have an additional $110,000 cash. So we want to talk a little bit about what we're going to do with that cash of $110,000. And so the Federal Reserve 7-member board kind of puts some, the scrimp on it. And they say, well, look at, you got to put some of that aside because people are going to be writing checks all the time. So I tell you what, I want you to put some required reserves away in the bank vault that you can't touch. But, the rest of it you can go ahead and you can loan out. How many of you have seen that, what's that, Jimmy Stewart movie everybody sees every Christmas?
It's a Wonderful Life.
Wonderful Life, yeah, It's a Wonderful Life. Now, how many of you have seen that movie? It's a wonderful. Yeah, that's a really. I love that movie because it really does show that the vulnerabilities built in to the banking system. And so what can happen, of course, is that it can loan all those excess reserves out. But the 7-member board and the FOMC puts in its own 2 cents worth. It does set what the required reserves have to be. Okay, and so we call that the reserve ratio, and it can vary. I'll show you some examples here from the Federal Reserve website, but it can vary depending upon how much you have in the bank, anywhere from 3% to 10%. I'm going to use 20% because it's a nice number that allows us to do some simple math, and you guys can keep track. So, but usually required reserves are anywhere between 3 and 10%. In England, interestingly enough, and you'll find why this is interesting in England, they don't have any required reserves. They get to loan all of it out. That's because, well, never mind, I won't go in there. So they don't really have any required reserves in England, and I won't go into the reasons why, but they get to loan every bit of it out. And it's interesting too, during the 2007, what was the one bank that actually had lines of people out the door? Wasn't it Northern Rock? Was it Northern Rock? I don't know if you were keeping. Yeah, they had a bank run in England during 2007, 2008 crisis. But England is interesting because they have this. Do you know what the city is? The city is like Wall Street. It's just like Wall Street in England, but it's a separate country. It doesn't have to abide by the rules in England. It's a completely separate country. So can you imagine Wall Street being a separate country in New York? Well, that's what they do in England. Yeah, it's kind of interesting. They have an interesting, and yet, okay, so let's move on. So, so they're not required to hold 100% of the deposits, which is nice because a lot of this money just sits anyway. And wouldn't it be nice to actually loan this money out, create jobs and create investment and, get the economy growing? So this isn't a bad thing, right? I mean, you do want to make sure you have some kind of, capital backup in case there's a run on the bank, right? But we have mechanisms to handle that as well. We have the FDIC insurance and some other mechanisms in place for the banks, and we'll talk about some of those mechanisms here in a minute. But the 7-member board and the FOMC will set the reserve requirements. And so the reserve ratio is typically the commercial bank's required reserves divided by the commercial bank's checkable deposit liabilities. And it's anywhere from, 3 to 10% usually of the total checkable deposits that a bank has on hand. And this is just a quick, I'm not going to go into this in any detail, but this is the Board of Governors. That's the 7 members elected by the President, appointed by the President, and they set the limits on the Federal Reserve requirements. You can see that the FOMC, which includes the private banks, they have 4 members of the Federal Reserve Board members on a rotating basis. There's 12 of them, so on a rotating basis, 4 of them join the Federal Open Market Committee. And I have to tell you a secret. Now, look at this. I just want to point this out, just in case anybody's interested. You see this? There's 4 of them right now in Congress. Right now, they're thinking of changing this, and it's in the committees right now being discussed. And how they're changing this is they want to make sure that all 12 of the Federal Reserve Board members or presidents are on this committee. If all 12 of them are on there, and there's only 7 members that are elected by the government, what would that do in essence? Anybody have any ideas? These guys set policy, monetary policy. You got private banks. These 12 member banks. See these are all private banks. There's a big bank right here. That's a Federal Reserve Bank. This is a Federal Reserve Bank. This is a Federal Reserve. These are all Federal Reserve banks, and they have presidents. And all of the private banks in these areas belong to that bank. That's where they bank. Okay? And so these presidents belong to this committee on a rotating basis, only 4 of them. Well, if there's only 4 and you got 7 members, well, the government then who elects these people still have, there's still some accountability from the federal government, right? But if you have all 12 of them in there, the 12 private banks can just overvote the 7 members boards that are elected by the president, and you in essence have a private banking system running monetary policy in the economy. What do you guys think about that?
Bad idea.
Doesn't that make you? It makes me a little uncomfortable. Because
Conflict of interest.
yeah, it's conflict of interest. Yeah, I mean it's conflict of interest just like this alone because these guys get to elect the people who manage. I mean these people here get to elect the people that actually audit them. Oh yeah, they elect the people that audit. Anyway, let's not go there. So the FOMC advises the reserve requirements, and this is the policy we're focused on right now. This is also a policy, and this is a policy, but we're just talking about this one right here, okay? And so this one right here is set. It's set within limits by the 7-member board, and it allows and it ensures that when you have checkable deposits, that there's some kind of a percentage of that that's actually put aside for safekeeping. And so this was it before, it was just changed, and I'll show you the update on the Federal Reserve Board. But this is what it was before. I just want to point this out. You can see that it was between 10 and 55 million, it's 3%, and over 55 million, it's 10%. Well, now look what's it's going to be come today. This is what it is today. Look how much it jumped by. 122 million. So now, if you have 122 million in checkable deposits, now you have to keep, if you have more than 122 million, you have to keep 10% aside as a reserve requirement. So this just gives you an idea of the percentages that they have to keep aside on checkable deposits. So here we go. So we're going to assume that the bank deposits all the cash at the Reserve Bank. In this case, it's San Francisco. So they take all the cash from the deposits that you put in there, and they put them into the Reserve Bank in Chicago. And now we had cash on hand, and we now have checkable deposits of 100,000. So in the Reserve Bank now, we have 110,000. And to identify of these reserves what's required and what's excess, we have to take whatever the percentage is, and we're going to assume a 20% because it's a nice clean number and easy to deal with. So let's just pretend that the reserve requirement is 20%, okay? So I'm going to say 20% on that 100,000. Okay, so that would be our reserve requirement, just for the heck of it. So that's going to determine our excess reserves, and it's going to determine our required reserves. Okay, so the required reserve is going to be 20,000. Excess reserves then would be, but the excess reserves, though, let's be careful when we talk about the excess reserves, because we take the excess reserves and we subtract it off of this. So the excess reserves end up being 90. We just, we take the required reserves and subtract it off this, and that's what we get to loan out. Okay, so off we go. We're going to use as our example a reserve ratio of 20%. And right now we have checkable deposits at 100,000. So in our example, excess reserves would equal 90,000, right? And which is actual reserves of 110,000 minus the required reserves as 20,000. Y'all with me? Mm-hmm. So here's transaction 5. We're going to clear a check. So did I loan anything yet? I didn't loan anything out yet. Okay, so we have reserves at 60,000. Somebody wrote a check while we were talking, and we just lost 50,000. Went to another bank, so off it went. And now we only have 60,000 in our reserves. We had 110. We have to subtract off 50,000 because somebody wrote a $50,000 check and put it in a different bank. So now our reserves went down. We still have to recalculate now. So now we have 50,000. So our required reserves are 10,000, right? Did I do my arithmetic right? So I have now total reserves of $60,000. So now what I'm going to do is let's loan some money out real quick. So let's loan some money out before somebody else writes a check, right? So we're going to loan $50,000 out. Anybody notice anything interesting that's happened here? I took $50,000. Look at this, a loan. I have a loan doc now that's sitting on my desk, and it says, Jimmy Stewart now owes me $50,000. It's a mortgage of some kind. What happened on the asset side? Was 50,000. Now it's 100. What happened? Whoa. Where'd that money come from? What'd the bank do? The bank just says, this is cool. See, we're a bank now, so we get to do this, right? So all we did is I just got onto my little computer and did some digital stuff, and poof, we just created new money. That's, simple. Well, who was it, Galbraith, that said it's so simple it's almost scary? Or did he say nauseating? Sorry. You caught on the sense of humor. So you can see, so far, we've just now added 50,000. This is not a real big deal because it's going to get, this is only one bank. We're creating money in just one bank, right? And so they can just, and again, this is not a bad thing. A lot of people get scared, right? But somehow you have to expand the money supply. And there's lots of designs, although Mervyn King once said that of all the designs, the current one that we picked probably is the worst. Mervyn King was the chairman of the central bank in England. And he recently retired a couple years ago. But somehow you got to get money out into the economy. And what are you gonna do? Helicopter drop it? Go out in a helicopter and just start drop. How do you do that? This is one technique. Getting money to people, right? Of course, another technique is cryptocurrencies. But personally, I find that kind of scary. But I like the idea of it being distributed. I just am kind of scared at the lack of understanding of what money is, but anyway. So this is not necessarily a bad thing. There are lots of ways to do this. It's not my favorite way of doing it. I have some other ideas of how I would like to do it, but this is one way of doing it. And this is how they decided to do it in 1913 when they created the Federal Reserve Board. So yes, private banks just, digitally add a brand new deposit when they made that loan. Jimmy Stewart borrowed money, and into Jimmy Stewart's account, they gave him $50,000, and it was just added to the money supply. Okay, so a single bank, but now here's one of the problems though. The single bank can only lend amount equal to its pre-loan excess reserve. So it's limited, right, by this model. This is, there's been some adjustments to this model in the past couple decades, but this model, it is limited by the excess reserves that are available by a single bank. So after a check is drawn on the bank, you can see what happens. What happens here is that they've drawn the check and they put, Jimmy Stewart doesn't belong to this bank, belongs to another bank, so he took his money out and put it into his own bank. So now what we have is $50,000 here, but now we only have $10,000, which is exactly what required reserves are required, right? So I can't, this is exactly what I need to back this amount up. And I only have this for loans, which is, not going to be, this is going to be sitting on my book for 30 years now until the house is paid off, right? And so I can't do anything more. I'm just kind of stuck unless I can get some more deposits. Remember back in this, here I am, showing my, advertising my, but there's some older people here. Remember when they used to give, back in the 60s and 70s, they used to give you these, hourglasses, and little tiny cups, and they used to give you all these presents if you put deposits into their banks. I don't know if you remember that, but because they needed more deposits. They couldn't loan any more out unless somebody else came in and put more deposits into the bank. There's other ways now. Banks now rely on external funding a lot now, but according to this technique, once its excess reserves are gone, that's it. They can't loan anymore. So the bank controls that. The Federal Reserve Board tries to control that. So that the money supply doesn't expand too much. Now, we've only done one bank here, so I just wanted to point out quickly that you can do the same thing when you buy securities in the secondary market for treasuries, and so you could either loan the money to for example, for a mortgage. The same process would happen if the bank wanted to buy a security in the secondary market. I just wanted to point that out. Okay, so now let's just talk a little bit about this. So the bank's job is to earn a profit, right? And it pays money on deposits and savings, and then it pays interest. It charges interest on loans, and that gap or that interest rate spread is where it gets its profit from, right? And so, or from securities, right? It can also purchase securities. And so its job is to earn a profit. That's what banks want to be able to do, right? To make a profit. Although if the Federal Reserve makes a profit, they're supposed to give that back to the federal government. But private banks can make a profit and earn a profit. And so they try to play this game between liquidity and increasing their profit. And they don't want money to be just sitting there idle because it's, it could be out there earning money for them and growing jobs and investing for us. And so it's kind of a good thing. You want them to be delicate about it, and you want them to be responsible, and you want them to maintain liquidity in case there is a big run or some scare. They want to be able to cover that. But there are some alternatives. If there is a run on the bank, banks do have the option of borrowing from other banks in the system. So they can borrow from fellow banks in the system through the Federal Reserve banks, right, the 12-member banks. They can also turn to the Federal Reserve Board and borrow from the Federal Reserve Board. They have to pay a higher interest rate on that. But usually they'll use the federal funds rate and borrow among the banks themselves. That's generally what will happen, unless there's some serious issues, in which case then of course they will turn to the Federal Reserve Board and borrow at the higher interest rates. They want to penalize these people so that they don't get used to turning to the Fed all the time. And so the Fed does charge higher interest rates to discourage them from relying heavily on that source as a fund for loans. So so these are alternatives, overnight bank loans from other banks, and using the federal funds rate or relying on the Federal Reserve as a lender of last resort. Okay, so there is, this is the age-old problem of profits versus liquidity. The Jimmy Stewart issue. I don't know if you remember the scene in Jimmy Stewart, and he asks everybody to calm down. The money's out there, of course, but it's in loans. It's in longer-term loans, and this maturity transformation of taking short-term deposits and turning them into long-term loans is what grows the economy, right? It creates investment opportunities. It allows you to build homes, and it allows the economy to grow. And so it's a good thing, but it does add an element of vulnerability to the system, right? If everybody goes to the bank at the same time, of course, the money's not there. It's wrapped up in long-term loans. And so this is a mechanism to create money, it's expanding the money supply, but it's also growing the economy. It's creating jobs, it's creating investment and growing. So so it's a good thing, if it's managed well and it's adhered to, right? So now let's take a look at the banking system as a whole. Right? We've only looked at one bank, the bank we just created. Now let's see what happens with the entire banking system. Well, we're going to find out that this multiple deposit expansion actually ends out creating what's referred to as a money multiplier. And this money multiplier then is going to allow the banks to actually generate much more money in the economy than actually was created by just simply one bank. So let's take an example. Let's suppose that all the banks have loaned out all their money and all the excess reserves are all gone, and so we're just kind of sitting there. And then somebody, was sitting on a couch and they found a $100 bill. Wow, right? So what are you going to do with this $100? I'm going to go deposit it. Yes, okay. So a $100 bill is found, completely brand new, just out of the blue, and the person goes and deposits it into the bank. So some bank now has some excess reserves. So what happens when that occurs? Well, multiple deposits on that $100 can actually be created across the banking system, okay? And so how does this happen? What did I just do? Oh, that's cool. I didn't know I did that. So let's see what happens. So Bank A gets new reserves of $100, right? Well, they have to take $20 of that out, right, and put it into the vault, and then they'll take the excess reserves of $80, right, and loan it out to somebody, right? And so that $80 goes someplace, doesn't matter where anymore, right, because we're talking about the entire system, right? So that now some other bank, we'll just say Bank B, has $80 in their account, deposits, right? Well, they get these new deposits, and they think, well, gee whiz, I only have to keep $16 of this. Right? So they take $16 as required reserves, put it into the vault, and they loan out $64. Huh? Cool, right? So they keep on this, now somebody other now might not be put in that bank, so we'll just say it gets put into Bank C, right? So Bank C gets $64. $64, they only have to keep $12.80 of it, required reserves, right? Poof, excess reserves get loaned out at $51.20, and it goes into Bank D. This process continues, right? It continues on until we end out all the way down until there's no more money left, right? And we end out with a total of $400. Don't forget the original $100 that was found in the couch. So $400 was added to the banking system in new money. That was brand new money that was added to the system just from that $100 bill. Now, you might think, oh, no, but, really, again, you want an elastic currency, and this is a good thing. Now, there's lots of things that can go wrong with this, lots, but I won't go into it. But if you follow this, and it's adhered to, it's a good thing, right? And because it helps the economy to grow. So we can take this amount of $400 and we can actually talk about a money multiplier. And the money multiplier is 1 over whatever the reserve ratio is. Okay, so our reserve ratio was 20.2, right? And so you can actually determine how much brand new money gets created into the economy based on the required reserves that's set by the Federal Reserve Board. Okay, and so in this case, of course, new money was created, the money multiplier. The maximum amount of new money is created by a single dollar of excess reserves. And of course, the higher the reserve ratio, the lower the money multiplier. And of course, the reversibility of that, of course, is also true. So we're making loans. By making loans, we create new money. And of course, let's also remember that when you pay off your debt, you're destroying money. So you're also destroying jobs. I just throw that out. It's true. I mean, the Federal Reserve really doesn't like the money supply going down. As a matter of fact, that was one of the biggest reasons of the Great Depression, and one of the main reasons why we had QE. The money supply had there was just a massive amount of money supply in 2008 that just evaporated. That just evaporated, and it wasn't in deposits. It was in the bottom of the money supply, in securities. There was the mortgage-backed securities that's considered money, and that evaporated. And it was such a massive amount that even the QE, that it took almost several years before they were even able to come close to the amount of money that had actually evaporated in the economy. So a lot of people were saying, oh my God, they're printing money, and look what they're doing. They're adding all this money, there's billions and trillions of dollars, and what are we going to do that's going to cause inflation? In fact, it took a long time before it actually was able to plug that hole of the amount of money that was actually destroying the economy during the 2008 crisis. So loan repayment, I should also point out that this system doesn't always work. Can anybody think of why the investment might not work? I mean, let's suppose we have a reserve ratio today of close to 0. Do you think people are going to go out and borrow money, and invest? So money demand makes a difference too. I don't know about you guys, but number one, there's not a lot of people buying and purchasing out there right now. And if I'm given a big lump of money, a lot of people are more inclined in this kind of an environment to buy down debt. And so if people are taking their money and their currency and buying down debt, they're still destroying currency. They're still destroying money, right? So you want to be careful that you don't assume that just because you have a reserve requirement that's extremely low, that you're going to get lots of money supply growing in the economy, because the only way you can get the growth to happen is if people want to take on loans, right? So you have to be willing to take on loans in order for the money supply to expand. And that's one of the biggest problems that the Fed had. Nobody was borrowing after the 2008 crisis, and they couldn't get the money into the system. Nobody wanted to borrow. Everybody was buying down debt and just destroying the money. And so they had to take some extreme measures to prevent that, for the economy from completely collapsing. So the money multiplier, if we begin with a $1,000 deposit and a required reserve ratio of 20%, 1 over 0.2 is 5, and that implies 5,000. Of course, minus the initial $1,000 that we started with, or $4,000. And this is a good trick. Keep this in mind in your AP exam. They always do this. They always ask how much money was created. It's not 5,000 that was created, right? And they always do that. It's only 4,000 that was actually created. The initial 1,000 was what we started out with. So the Federal Reserve can increase the base money with also by purchasing securities as well. So say the Fed increases reserves by 1,000, it increases the money supply by a full. If the Fed does this, then the Fed can increase the full amount by 5,000. If the Fed starts out by adding 1,000, right? So you have to draw the distinction. So banks are credit creators; they're not intermediating, right? And that's one of the big fallacies that a lot of people, I'll never forget Jamie Dimon coming on in a Senate committee, and he was saying, he was giving the big sob story. He says, well, we're doing God's work. We're intermediating savings and helping people to invest. And he was getting his hand slapped. Somebody else, a bunch of banks were getting their hands slapped. This was during the London whale, and a lot of people and a lot of banks, Goldman Sachs too, was engaging in taking depositors' money and gambling with it essentially in the derivatives market. And who was it that lost $6.2 billion of depositors' money? So he was on. He was being given a hard time for it, and they don't really intermediate savings. That's kind of a Keynesian economics teaches us that, but that's not really what goes on. What really goes on is that banks create money when they make loans. There's not a lot of intermediating that actually really goes on. So they create credit, and that means they create money, which means that all deposit money that is in the deposit accounts right now in banks is some form of debt, belongs to somebody. It's somebody's debt, it's somebody's liability. And this is what we mean by a fractional reserve system. It's fractional because they only have to keep a certain fraction of your deposits on hand for you when you write your check. It's fractional in that they only have to keep required reserves on hand. And so that's what we mean by a fractional reserve system. By a fiat system, anybody know what fiat means? By a fiat fractional system, I mean, we used to have a fractional reserve system, but it was based on gold, and so it was backed by commodities, gold in this case. But fiat means that it is only backed by government faith. The government will accept that money and to pay taxes and to pay debt. And so because of that, we call that a fiat fractional reserve system, and that's what we have today in America, in the United States. But I do have to say that we are unique in all of the developed world. We're unique in that we have a combination of private and public banks that run our monetary policy. That's not true in Canada, that's not true in Europe, and that's not true in England. It's completely owned, managed by the government in those other countries. We are it's been a delicate mix, and currently it is being thrown into. I have no idea. I mean, I just listened to who was it, Dean Baker. It was a really good talk, and he just threw up his hands. He says, "I don't know, I have any idea what you guys are thinking of. You're turning over the entire monetary policy to private banks. What are you thinking? And this is somebody that I have a lot of respect for. And it's I don't know. Does anybody know anything about the new? Janet Yellen's not going to be will not be the chairman anymore. Do you know anything about the new one? He has no economics background. He's from the financial industry. I don't know. I'm a little concerned. I don't know. Maybe he'll be good. I mean, I don't know. We've never had somebody that didn't have an economic training. This is a first. It's all part of the new normal that we all live in. But monetary policy is economics. That's what economics is all about, right? It's just economic theory. So I'm a little concerned, but it's the board has a lot of backups. They have a lot of. It's not like Powell's going to make all the decisions. They do it. They have a huge team, and every one of even though they're the Federal Reserve Board presidents of the 12-member banks, even though they don't vote, only 4 of them vote. They all go to the meetings and give their opinions on the state of the economy and what they think should happen. So that's a good thing. And so it's not like he's going to be operating in isolation, and I doubt there's very few people. I mean, Greenspan was unique in that way. Very few chairmen make decisions, on their own. Greenspan was kind of out there on his own. He did make some pretty, even though people disagreed with him, he would do what he thought was best. Bank panic of 1930 to 33. Of course, it happened in 29, but it really didn't stop until 33 and got really, really bad in 33. This was before deposit insurance. We have FDIC now. Unfortunately, I think the FDIC only has $33 billion in the FDIC, and we have trillions as deposits. So let's hope they all don't go. Anyway, so bank failure does lead to mass withdrawal. That's what happens. Forced it can result in forced loan reductions. During from 30 to 1933, there was approximately a 33% decline in the money supply. And what finally had to happen was a bank holiday. They just shut all the banks down, and they, of course, all of this contributed to the Great Depression. They also froze gold. They made everybody give up their gold, and froze the banks, and then implemented the Glass-Steagall Act, which I'm a big fan of, huge fan of. But part of the Glass-Steagall Act was the FDIC insurance, and that reassured people's sensibilities of putting their money back into banks. So with regulation, we try to protect the system today, of course. And that's really all I have. Does anybody have any questions? No? Yes?
mentioning that sometimes banks take loans from other banks. Does
Yes.
it ever happen that those other banks refuse to lend to them if they're too shaky and then they have to borrow from the Federal Reserve?
That's a funny question. That's a funny question because during the 2008 financial crisis, nobody would loan anything to anybody, and everything just froze. Because nobody knew who was a bad bank. Nobody knew if they could pay it back. And typically during crises like that, the only people that want to borrow, right, are people that really, really need it. And you can tell they really, really need it. You know how? Charge outrageous interest rates and watch how eager they are to pay it. But yeah, nobody would loan. The banking system completely froze. No, everybody was scared. And when the Federal Reserve stepped forward and says, "Oh, don't worry about it. Come to the window. We'll loan it to you." All the banks just went into the shadows and started hiding, because if they went there and everybody saw that they were borrowing to the lender of last resort, then of course everybody would think, "Oh my God, my deposits are," and there would be a run on the bank. So nobody wanted to admit it. And so the Fed had to figure out some way of getting this money out to the banks without making it apparent that the bank needed it. So what did it do? Gave to everybody. Just gave to everybody.
Made them take it.
Made them take it. Oh, very good. Yeah, go ahead. What you want to? Yeah, yeah. Yeah, they had, they also, and I probably shouldn't say this, but there was also an additional, while they were arguing in Congress, I think it was like, what was it, $60 billion. They wanted, who was it, Paulson, who worked for Goldman Sachs, he was the Treasury at the time. He wanted to, I think it was like, I don't know, 80 billion or something. They were going on and back and forth, and Congress was saying, "Well, you have to tell me why you need it." And Paulson says, "Well, if you don't give it to me by tomorrow, the entire world's going to, come to a, the entire world will collapse." No, really, he did. He typically, in these kinds of requests to Congress, you have this gigantic book, 500 pages, and you give it to Congress and they analyze it. He gave him 3 pages. 3 pages, that's all. And said, "I want the money, and I want the money now." And that was it. And he says, "If you don't give it to me, then the entire global system is going to collapse." But while that was going on, Ben Bernanke was taking, what was it, $15 trillion without anybody knowing, and giving that to foreign banks to keep the system going. Now, that was found out because Bloomberg requested some documents and was able to get them, and was able to show that $15 trillion, that's a T, with a T, trillion, $15 trillion was given to foreign banks. And, again, lender of last resort, was I against that? Well, I'm against what happened beforehand. I'm not so against what they did to stop the world from collapsing. What I am against now is that not enough has been done to prevent it from happening again. That's what worries me, and to see what's going on in the Financial Services Committee right now, is very disturbing. And it's not like people don't know. There's a lot of economists that are coming forward and saying, you need to stop this from happening. We do not want private banks managing our monetary policy. It's just not wise. It's just not a good thing to be doing. And, we'll have to see how that plays out. Yes?
How do you think this blockchain cryptocurrency thing is going to affect that banking system?
Well, when I first read about it, and this is before Bitcoin went nuts, and started being incredibly volatile, I thought it was the neatest thing in the world. I thought this blockchain stuff is just awesome. It's just, and I still think that. I think the blockchain technology is just a really powerful way, because right now it's incredibly expensive to process the payment system. The payment system is just incredibly, not only complex, but it's making massive errors, horrible errors. It's just really bad. And this blockchain technology is not only cheap, but a really clean way of doing it. So that technology I believe, is going to be applied to the payment system. There's no question about that. Whether or not you can use coins that use this blockchain technology, coins that have to be mined, I'm going to qualify that, because once they have to be mined, it's not scalable, and they limit the amount of the money, and so that makes the price too volatile. And you can't have a currency with a volatile price, 'cause, you go to buy a loaf of bread, and today Bitcoin's $16,000 and tomorrow it's, $9 and, and not only that, but to buy it. Have you ever got into there and tried to buy a coin?
Yeah.
How successful are you?
It's as sketchy as it gets.
Yeah, I've been trying for 2 months. They won't let me do it. I've been trying to, all I want to do is take a simple $50 bill. I'm willing to throw it away. I don't care what happens to it. I just want to experience this idea of cryptocurrency and get some, roll up my sleeve and jump in there and see how it works. I still haven't been able to buy a Bitcoin.
Start an account at Coinbase.
Oh, I've been there. I did that.
Oh,
yeah, I did that.
That's the easiest place.
No, that's what I
did.
did.
It's not easy.
What?
It's not easy.
No.
But it's one of the easiest places to start.
Yeah, I did that. But there's rumors going out, and I could be because I'm an economist, at a university. There are rumors going out that they're trying to stop people in the United States from buying coins, period.
Right.
And so, but if you have a business, they'll let you do it. But they won't and once you are in it, then of course you can trade.
Yeah.
But the problem is they get in your bank to into the cryptocurrency to purchase it. That's the big issue. And so there's people, foreigners can, because of course this blockchain technology, the ledgers are controlled all over the world, right?
Right.
And so people all over the world are doing it. But what do you think about private people creating money? How does that make you feel?
That's fantastic. I don't know. I'm pretty stoked about the peer-to-peer sharing and
Yeah.
cutting out like a lot of this.
I am too,
A lot
but-
of this control that you were talking about.
But let me ask you this question. Let's just say let's just simplify it and say there's only Bitcoin. Now, Bitcoin is just a currency that just somebody created, and it's to increase the money supply by a certain amount. Outside of the Federal Reserve Board control. It's just brand new money. You know what that brand new money does to the dollar in my back pocket? If people are trading in it and buying the goods and services with it, it deteriorates my dollar.
Right. Right now, the ground's shaking.
Yeah, the ground's shaking.
Things are going to change
Yeah.
real fast.
I don't know how they can stop it from happening. That's what's scary.
I don't think you can. So if you can't beat them, you got to join them. And what
Yeah.
I see happening already is these places are all setting up. Almost every industry is setting up with their own types of coins.
Yeah.
I mean, it starts to make. It took me a long time to understand it. I don't fully understand it. I've been.
I find it pretty scary stuff.
I've day traded on E-Trade for 7 years, and when I stumbled across this and started trading on GDAX, it's been about 30 days.
Yeah.
I don't even open my E-Trade account anymore.
Yeah, I know.
just want to do this.
That's what's scary.
Yeah.
Because it's
That
not a
volatility. I can make money now.
That's exactly my point. It's not a currency, it's an asset, and it's a bubble. And when that bubble pops, they've already created exchanges in Chicago, 2 of them in Chicago.
Exactly.
And what happens when those bubbles pop in Chicago is that everybody has to cover their margins. And when they do, it takes it out of all the other commodities to cover the Bitcoin currency. And so it can cause massive disruption in the real economy. And I don't find that real funny.
Right. Well, we are where we are.
We are
You
where
know,
we are.
We got to live today, and so
Yeah, I
don't
know.
I figure ride it. you
Yeah,
know.
I know. Yeah, hey, I'm not putting that down yet. I don't feel. I mean, I have a sense of responsibility as an economist. I don't want to get engaged in the bubble aspect of it, but I do want to study it. I find it because money is my,
Fascinating.
I'm fascinated with the way what money is and how it gets created. Does anybody have? Yes.
So, does the Community Reinvestment Act actually hold back banks from serving low-income areas?
Community bank. Can you ask that question again?
Does, the Community Reinvestment Act, does
I
that
remember
prevent
that.
banks from serving the low-income areas?
I'm not. I'm not sure I can remember offhand with the community.
It's
You
like
know?
they're required to serve the low-income areas, and there's regulations and all types of loan they're supposed to serve. And
Yeah, I'm not familiar with that. Yeah. But share with us. Talk about it. We'll good student. You have a good student here, right?
Yeah, true.
Sure am. Awesome.
I think what happens is it depends on how it's implemented. If you're a big bank that doesn't have those types of accepted loan targets in your target area, you can, if I was here in Ketchikan and I don't have the quality for a CRA loan, I don't have to spend the money in Ketchikan. I can buy those credits from banks somewhere else, and it doesn't benefit my community at all.
Yeah.
And in that instance, no, it doesn't benefit your local community. And there are no requirements for what percentage you have to spend. Now, most of the local banks in Alaska do stay within Alaska if you're a community bank.
That's actually a really interesting thing to look
If
into.
you're Wells Fargo, or if you're
I'd like to
a
look into
key
that.
bank, you
Yeah.
don't have that requirement, you don't have to spend money.
Yeah, I spend a lot of time with big banks in Wall Street, a lot, so I don't spend, and I should. And because what's interesting is that during the Great Depression, it was the small banks that caused the crash, because the small banks were the wildcat banks, so to speak, because they didn't belong to the Federal Reserve. You know, they chose not to belong to the Federal Reserve. And so they were out there making all these loans, and not paying attention to required reserves. And so they were the ones that had a lot of the problems. Well, now the tables have turned, and now what we have are the big banks that are, doing, engaging in all the fraud and massive amount of leveraging that's been going on with the derivative trading, et cetera. And so they're the ones really that have been causing a lot of the problems. And that's really what a lot of my studies have been focused on. But I haven't spent a lot of time on the community banks. I have to say, though, I trust community banks a lot more than I do the larger banks. And the reason is that they tend not to engage in securities as much. So this picture that I've been showing you here, this picture pretty much probably still holds for these guys, right? It doesn't hold for the banks that, are these gigantic banks, because they use external funding. And so they're not limited like these smaller banks. And so because these smaller banks don't engage in the securities market, selling off their loans into securitization, they tend to be more stable. Should I say that to, then, is there anybody here that belongs to the big banks? I have to be careful because, you don't want to, you have to be careful in small communities. But I do tend to trust community banks. I tend to trust community banks more because they do tend not to engage in the securitization process. They do tend to hold their loans for the lifetime of the loan. They make a loan for 30 years, they hang on to it. They don't sell it off to some security firm to securitize it and sell it to investors. And that's where you start getting into trouble, because then you're dealing with the originate to distribute model of banking and not the originate to hold banking model. And it's the originate to distribute banking model that really triggered all the problems. I talked about that a couple years ago here. I don't know if anybody here remembers that lecture, but it's a brand new model that started after we went off the gold standard. And once we went off the gold standard, beginning in the mid-'80s, we started with a brand new banking model called that securitizes loans, so that banks don't hold loans anymore, they sell them off. They sell them and securitize them and sell them as securities, and people invest in them. Anyway, anybody have any other questions? Yes.
Is there a lot of difference between the way rules governing banks and rules governing savings and loans?
The savings and loans institutions crashed in the 80s. I don't know if you remember that. They had a huge crash in the 80s. And basically the same thing happened in the 80s that happened to the big banks in 2008. And so they pretty much tried to clean that up and required bigger capital base to those banks. And so savings and loans tend to be safer bets today. Yeah, but see, it's not me. It's Mervyn King. I always say this. Mervyn King, who retired, who was the chairman of the Schwabel, who was the central bank in Germany, who just recently retired last year. Bernanke retired, and now Yellen. I'm waiting for Yellen. But all these guys, when they retire, then after they retire, they come on board and say, oh, by the way, you know what? We're going to have another financial crisis, and it's going to be a doozy. Why didn't they tell us that when they were in charge? I don't get that. Am I missing something? They create the scenario, and then they retire and say, oh, by the way.
To have that illusion of stability.
Yeah. But to answer your question, the savings and loans, there was a lot of regulations that were put in place to try to clean those up when they crashed heavily in the late 80s. I don't know if you remember that, but I remember it. As a matter of fact, I took all my money out of my bank and put it into a safety deposit. I did. I studied the Great Depression, so these things aren't, to people nowadays it seems hard to believe, but in the Great Depression they just one day the president stood up and said, hey, guess what? You can't get any money out of your bank today. That's it. They're all closed. They're done. Can't go to the bank. And they closed all the banks, and then they made everybody turn in all their gold, and then many people only got so many cents on the dollar. So I'd been studying it, and I'm a little more comfortable now. I mean, we'd all be in the same band, same. But anyway, so yeah. Hope that answers your question. Yes, you
I
had
have a friend who she lost her savings when Washington Mutual went under.
I'm so sorry to hear that.
And my mouth just like, how could that
I know.
They
Well,
weren't-
Weyerhaeuser.
They weren't too big to fail, I guess, and.
Weyerhaeuser, I don't know if you remember, but I worked for Boeing for many years, and I had a friend that worked for Weyerhaeuser, and Weyerhaeuser lost all the pension funds. Yeah. How does that happen? I just thought, I'm in Boeing. I know. Yeah, you can't believe it happens until it does. That's the problem. But anyway, yes.
So the required reserve ratio, 3% and 10%. Why have those two numbers? Why not have a whole bunch? Why not have a continuum? And it seems like with the too big to fail concept, shouldn't those even bigger banks have additional requirements?
If you actually
or-
looked at the details.
And where does that come from? I guess what's the
If
history
you
of
look
that?
at the details of this, I have a class that I actually teach on this. If you look at the details, this 3%, 10% is just bull. So, excuse me, nobody keeps that aside. Nobody does. I mean, do you know what a sweep is? What a sweep is at the end, right before night falls, right? They take all the money out of the deposits. It's called a sweep. They take all the money out of the deposits and put it into the repo market. And so there aren't any deposits. They're not there. And on top of that, most of the deposits, remember deposits are, a lot of those are loans. So many of those loans are just sold off, lock, stock, and barrel. So they're not even part of the 10% or the 3%. There are so many ways of getting around those reserve requirements. It's really pointless. Really, it's really. I mean, there's just dozens of ways. I mean, they're not going to ask you that on their AP exam. They're going to stick to the standard theory, but those required reserve. And in fact, in real life, required reserves aren't even hardly used as a policy anymore because of the fact that it's so easy to get around them via sweeps and other means.
So they don't adjust them. They haven't
That hardly
considered
ever.
adjusting them since the recession is not even a factor
Hardly ever.
anymore.
It's a way of controlling the quantity of money. And so the technique of controlling the quantity of money now is QE. They buy treasuries. They buy mortgage-backed securities. They buy all these securities from banks. And so they basically, if they want to control the quantity of money, they're going to use QE. If they want to control the price, they're going to use interest rates. And so for the most part, for the past couple decades, we've really used interest rates almost exclusively. And we're more and more engaging in the repo market, which is really scary. But so the repo market has become really, and the originated.
We by private banks or the Federal Reserve?
The Federal
as well?
Reserve is trying to, yeah.
Money
yeah.
supply through the repo market.
Yeah, the Federal Reserve, for the most part, the FOMC and the board itself, pretty much uses interest rates solely. That's the word, right? But they're really also engaging heavily in the repo market, and of course QE. They never really have stopped QE. That's continued, and they're thinking of making that part of standard policy now, QE. As a means of controlling the money supply. The banking structure that we teach, and this is what we teach in all our econ classes. This is a standard lecture in economics, but this model, it doesn't exist anymore. I hate to tell you that. We have what's called an originate to distribute banking model now. And when banks make a loan, they don't hold it on their books anymore, except for the community banks, as you pointed out. The community banks, many of the community banks do, but most of the big banks don't. They sell off these loans to securities, and the security firms turn them into mortgage-backed securities, and then sell the mortgage-backed securities as investments. And so, because the banks don't hold these loans on their books anymore, they don't have to worry about, required reserves and, because they're not part of the deposits anymore. So, yeah, originate to distribute model is really interesting, what's going on in the banking industry. It's, what's disturbing about it is that new forms of money are being created. A lot of people talk about cryptocurrencies. Well, there's a lot more, mortgage-backed securities are money, right? Securities is money, treasuries are money. And so these are new forms of money that the banking system, financial system creates outside of the Federal Reserve Board, right? And so the Federal Reserve Board doesn't control all of the money in the economy, right? It only controls deposits, and it's struggling. Okay, so I can see I've taken up too much time and I don't want to do it again. I did that last time. So.
Everyone, please join me in giving Ann a round of applause. Thank you so much.